Here's a question for you. What happens if you bet everything on one stock, and it goes to zero? It's not a hypothetical. It happened to people who put their savings into Enron, Lehman Brothers, and even well-known companies that seemed untouchable. Today, we're talking about diversification, the single most important risk management tool available to everyday investors. By the end of this video, you'll understand exactly why diversification matters, how it works mathematically, and how you can apply it to your own portfolio starting today. This is educational content, not financial advice, but these are principles backed by decades of data. Let's start with the basics. Diversification means spreading your investments across different assets, sectors, and geographies, so that no single investment can wipe out your entire portfolio. Think about it this way. If you own stock in 500 different companies, and one of them collapses, you've lost maybe 0.2% of your portfolio. But if you owned only that one stock, you've lost everything. Diversification isn't just about owning a lot of stocks, though. True diversification means spreading across different asset classes: stocks, bonds, real estate, commodities, and cash. Each of these tends to react differently to economic conditions, and that's exactly the point. Here's where it gets really interesting. The magic of diversification comes down to a concept called correlation. That's simply a measure of how two investments move relative to each other. When stocks drop, high-quality bonds often hold steady, or even rise. That's low or negative correlation, and it's the engine that powers diversification. Nobel Prize-winning economist Harry Markowitz proved mathematically in 1952 that combining assets with low correlation actually reduces the overall risk of your portfolio, without necessarily sacrificing returns. This is called modern portfolio theory, and it's the foundation of how institutional investors manage trillions of dollars today. The data is clear. Mixing uncorrelated assets makes your portfolio more stable. Let's look at the data. This chart shows the average annual returns of major asset classes over roughly the past 2 decades. U.S. stocks, represented by the S&P 500, have historically returned around 10% annually on average. International stocks have returned closer to 6 to 7%. Bonds have averaged around 4 to 5%. Real estate investment trusts, or REITs, have historically averaged near 9%. And cash and short-term savings? Less than 2%, which barely keeps up with inflation. No single asset class wins every year. But a well-diversified portfolio that holds all of these has historically delivered solid, more consistent returns with lower volatility than any single bet. That's the power of spreading your risk. Now here's something that really puts diversification in perspective. This chart shows the S&P 500 index over the past 25 years. You can see incredible growth, but also brutal drops. The dot-com crash in 2000 saw the market fall nearly 50%. The 2008 financial crisis wiped out about 57% of value. And in March 2020, the COVID crash dropped the market roughly 34% in just 5 weeks. Investors who were only in the S&P 500 felt every one of those gut punches. Now, a diversified investor who also held bonds, international stocks, and real estate still felt the pain, but significantly less of it. Bonds, for example, actually gained value during parts of 2008 and 2020. Diversification doesn't eliminate losses, but it can dramatically soften the blow. Let that number sink in. Negative 57%. That's how much the S&P 500 dropped from its peak to its trough during the 2008 financial crisis. If you had $100,000 invested entirely in stocks in October 2007, by March 2009 you had roughly $43,000. That's not just a paper loss. For many Americans who were close to retirement, that was devastating and irreversible. Now, a diversified portfolio that included bonds and other assets during that same period lost significantly less. Some balanced portfolios dropped only 25 to 35%. Still painful, but the difference between a setback and a catastrophe. This is exactly why diversification isn't optional. It's essential. Okay, so how do you actually do this? The good news is that diversification has never been easier or cheaper than it is today. First, index funds and ETFs, exchange-traded funds, are your best friends. A single S&P 500 index fund gives you exposure to 500 of the largest U.S. companies instantly. A total market fund goes even further, covering thousands of U.S. stocks. Add an international index fund, and you've now got exposure to developed and emerging markets worldwide. Then layer in a bond fund for stability. Consider a REIT, a real estate investment trust, for real estate exposure without buying property. Some target date retirement funds do all of this automatically in one single fund. The cost to build a diversified portfolio today? As little as a few dollars with zero trading commissions. Here's a sample diversified portfolio allocation that many financial experts reference as a solid starting point for a moderate risk investor. About 40% in U.S. stocks, that's your core growth engine. 25% in international stocks, that's your global exposure. 15% in U.S. bonds, that's your stability cushion. 10% in REITs for real estate, and 10% in short-term bonds or cash equivalents for liquidity. Now, your specific allocation should depend on your age, risk tolerance, and time horizon. A 30-year-old can afford more stocks. A 60-year-old approaching retirement might shift more toward bonds. But this chart gives you a framework to think about. The key insight is, no single asset dominates, and each serves a specific role in the portfolio. Now let's talk about what not to do. Because diversification done wrong can actually hurt you. Mistake number 1. Owning 10 different S&P 500 funds thinking you're diversified. You're not. You're just buying the same 500 companies 10 times over. That's redundancy, not diversification. Mistake number 2. Ignoring international stocks. Nearly half of the world's stock market value is outside the United States. Skipping it means missing enormous opportunities. Mistake number 3. Owning 30 tech stocks and thinking you're diversified. If the tech sector drops 40%, your whole portfolio drops with it. Sector concentration is still concentration. And finally, not rebalancing. Over time, your winners grow and your losers shrink, which means your allocation drifts. Rebalancing once a year keeps your risk profile on target. Let me give you a real-world comparison. Imagine two investors in the year 2000, each with $50,000. Investor A puts everything into tech stocks. It was the hot sector. Everyone was doing it. Investor B builds a diversified portfolio, U.S. stocks, international stocks, bonds, and REITs. By 2002, after the dot-com crash, Investor A has lost roughly 80% and is sitting on about $10,000. Investor B is down maybe 15 to 20%, sitting on around $40,000. Fast forward to 2010. Investor A has recovered somewhat but is still below their starting point. Investor B, up significantly, compounding steadily. This isn't cherry-picked data. It reflects how real market cycles play out. Concentration amplifies both gains and losses. For most investors, stability and consistency build more long-term wealth. Here's a number worth knowing. A classic 60-40 portfolio, that's 60% stocks and 40% bonds, has historically returned about 9.1% annually on average, based on long-term data going back to 1926. That's nearly as strong as an all-stock portfolio, which has averaged around 10.3% over the same period, but with meaningfully lower volatility. For a lot of investors, that trade-off makes total sense. You're giving up a little over 1% in average returns in exchange for a significantly smoother ride. And behaviorally, that matters enormously, because investors who panic and sell during crashes end up with far worse outcomes than the market itself delivered. Staying invested through downturns is easier when your portfolio isn't swinging wildly. Let's bring this home, literally to your own retirement accounts. Whether you have a 401k through your employer or an IRA you manage yourself, diversification applies directly. In your 401k, don't just pick one or two funds. Look at the fund options available and choose across categories. A U.S. stock index fund, an international fund, and a bond fund at minimum. Many 401k plans offer target date funds. Those are funds that automatically adjust your allocation as you approach retirement, getting more conservative over time. They're a simple, low-cost way to stay diversified without thinking about it. One major warning: avoid holding too much company stock. Employees at Enron learned this lesson the hardest way imaginable. Their retirement savings were wiped out alongside their jobs. Let's bring it all together. Diversification is not about being timid. It's about being smart. The evidence is overwhelming. Spreading your investments across asset classes, geographies, and sectors reduces risk without sacrificing meaningful long-term returns. Here's exactly what you can do right now. Number 1. Check your current portfolio and see how concentrated it is. Are you all in one sector or one country? Number 2. Consider low-cost index funds and ETFs to build instant diversification. Number 3. Make sure your 401k or IRA includes international and bond exposure, not just US stocks. Number 4. Set a calendar reminder to rebalance once a year. These aren't complicated moves, but they are the moves that separate disciplined long-term investors from those who get wiped out by the next market crash. Build wealth with knowledge, not guesswork. Before you go, everything in this video is for educational purposes only and does not constitute financial advice. Past performance does not guarantee future results, and all investments carry risk, including the possible loss of principal. Please consult a licensed financial advisor